Hi, so we're just starting our next panel, which I know a lot of you guys here are interested in, the intersection of these crazy new technologies and legacy institutions. Just to give you a heads up on the schedule, we are running this panel for a little bit less time, but and we're going to break for lunch in about 45 minutes to an hour. We are also at lunch having an announcement by the British Standards Institute. So they are interested in forming standards around digital currencies, one of the largest standards bodies in the world, and they want to come and describe their process, who they are, and where we can get involved as experts, as practitioners, to help educate the standards body about what proper standards might look like. So here we've got really a wide bench a deep bench of experts across many different expertise. So what I'd like to hear about is actually, when I first got into the space, these technologies were not very well understood. A lot of the political discourse and public discourse around the technologies were colored by the scandals, Silk Road, Mt. Gox, very nascent early ecosystem of entrepreneurs, and some fundamental understandings about how the technology works. I think the little cartoon up here earlier with the elephant was an apt analogy. So, what's actually been really extraordinary is seeing the change that's happened over the last couple of years, where banks and financial institutions that once didn't want to touch the technology, in fact didn't want to even be publicly associated with such technologies, are now actually coming to us and asking for information, setting up innovation labs around the world. Coming to these conferences to learn more. So I'd like these panelists to actually introduce themselves, give the audience a little bit of a flavor of what you guys have been working on, and also and then we'll dive right into how we've seen this intersection happen. So.
Sure. Hello, I'm George Hallam, Business and Partnership Director at Ethereum. Previously, I worked in the oil and gas industry, mainly in Nigeria, focusing on local content and ministry policy. My role at Ethereum sees me very much interacting with legacy institutions. I spend a lot of time talking to them about educating them in terms of how they could potentially utilize the Ethereum technological stack. I also work extensively with the Ethereum community and assist with startups and people who are looking to build decentralized applications.
Emirdag. My background is in electronic trading, market structures, and I worked at exchanges, fintech companies, and brokers, like a number of different places really, looking at more innovation in capital markets. I mean, the things that we worked on were quite innovative in capital markets. And last 2 years I've been looking at blockchain technologies, and now I'm on the advisory board of a few companies, and I'm actually looking to how to potentially close that gap and bring the blockchain technologies in financial services if it makes sense. And that's also a question.
My name is Richard Levin. I'm a partner with the global law firm of Bryan. We're about 1,200 lawyers with offices all over the world. I started off in the financial services industry. Pinar's company, Citibank, bought my first company, NextTrade actually. I've been in the industry since the late 90s, focusing on the application of technology to electronic trading. My current clients are investment banks, broker-dealers, exchanges, hedge funds, peer-to-peer lending platforms, crowdfunding platforms, and of course, people in the blockchain space. We just are launching a new digital currency team that I'm going to be co-leading with one of my partners, Judith Reiners.
My name is Amy Kim. I'm a lawyer at a U.S. law firm called Buckley Sandler. We're a boutique, mid-sized firm based in Washington, D.C., and we're primarily focused on the financial services industry. So our clients are banks of all sizes, large, smaller community banks, credit card companies, mortgage servicers, lenders, auto lenders, and payment innovators and emerging payments industry. My role in all that is to advise those types of institutions on anti-money laundering compliance, sanctions compliance, and then developing strategies within that to move forward, whether you're included in that regime or outside of that regime and need to interact with actors in that space. So that's a little bit of background on me, but I think, Constance, you also asked, what have we been doing, how we've been seeing this stuff in the space. I'll just briefly, what we've been seeing is, maybe the last year or 2, 3, 4 years, originally it was how are banks seeing this activity run through their institutions. So when their customers are doing it, under U.S. Laws, anti-money laundering laws, you need to understand who your customer is, so that you have a baseline, monitor their activities so that you can identify what is expected and what is unusual, and then once it's unusual, report that as suspicious. So that's really where it first started, when this industry was first kind of getting up and running, and then that evolved into whether banks should offer account services to these companies as a business. And that's been very controversial in the United States. There's been very high-profile anti-money laundering enforcement actions, not just in virtual currency, but full range of issues. And so they are very reticent, to say the least, to take on something that is seen as high risk and new, and really that many don't yet understand. So even taking on that kind of customer has been considerations that we've dealt with, and in some cases whether to close accounts, and to close accounts across broad industries, not just customer by customer. So then, fast forward to the last 6 months now, and we've all been talking about this, is seeing more of the legacy institutions take notice. This is here to stay. There is something underlying this other than the headlines, and how can we use this so that we're not the next blockbuster of payments, right? So we see it publicly, some banks like USAA, ING, others, developing, putting in resources, and then also quiet inquiries, quietly educating themselves and getting up to speed. And just my last thought on that is it is still kind of a polar dichotomy. There's very segmented areas of banks that seem to be looking at this, but the broad banking industry, I think, still is skeptical. These recent headlines that seem to come every week are definitely impacting this, and we need to overcome that hurdle. It's a perception. Clearly, there's a lot of out there that we can help, or that will help banks improve exponentially, but the perception, I think, is still something that I'm seeing a lot.
Angus Champion to Crespigny. I'm with Ernst & Young and leading driving our digital currency and asset opportunities from the US. We have for some time now provided services to the startups, but what we're looking at a lot more now is the legacy institutions, not just the financial institutions, but also non-financial institution, looking at different ways in which they can manage assets or can use blockchain technologies to as a distributed application environment for reducing infrastructure costs or reducing middlemen or parties within the system. The conversation has evolved over the last couple of years. We've seen very limited interest in Bitcoin as such, but the technology itself and its ability to come to consensus without requiring any centralized party has been recognized as being very powerful. And we've had varied discussions on that with non-financial institutions that are looking for better ways to manage their assets or agree on contracts or anything that in the traditionally has been difficult to manage. On the financial institution side, there is a lot of discussion around it because while there are some services out there or some solutions that do improve payments, they do see this as broader than just financial money payments. There's settlement of securities, transferring of ledgers, work between different branches or different legal entities. They're all looking at it, and it's the dialogue that we have with those, the different levels of what people want to say and what they don't, certainly has been changing a lot over the last year. From a year ago, it was not really sure why we'd look at Bitcoin, to understanding that it's a much broader game than that now.
Mehul, Desai. My background is in secure transactions. I've been working on digital wallets, mobile wallets, and a term we coined lifestyle containers for a good part of the last 2 decades now. The work that we've done has taken us to lots of different industries, banks, financial entities, retail players, healthcare players, government agencies, and so on. And essentially what we ended up building was an infrastructure platform which had a lot of the elements of now what the underlying blockchain technologies have and promise. So well versed with the concepts, have had several hard knocks over the years in terms of what works and what may not work. And in the last couple years in particular, what we're now finding is kind of a growing conversation around having a utility which cuts across all of these sectors. And I use the word utility in a very broad sense with no kind of regulatory connotations around it. But essentially saying that the underpinnings for any personalized transaction, I know there's a lot of focus on finance in general, whether it's banks or securities or smart contracts or what have you. But if you move across retail, you move across healthcare, you move across government services, if you kind of take the gamut of these and if you look at the underpinnings, the utility structure is fairly common across all of them. The usability obviously which gets built on it is different, and the drivers which take that usability forward are different. So effectively where we're now coming out is saying that the promise of blockchain definitely lies in the utility across the board. And from there on out, just a couple observations. There's still, so I continue to interact with a lot of financial players, players on the telecommunications side, on the large retail side. And I also interact with regulatory agencies, the Federal Reserve in particular. And so, but not to single anyone out, but one, there continues to be confusion, wrongly so, between Bitcoin and blockchain. And I'm sure this has come up at least several times in the past few days. But I think that's one area which all of us in this group in particular needs to focus on sensitizing. I think everyone in this room gets it, but in the outside world there continues to be that confusion, which is not helpful in any way. And two, the conversations around blockchain, in my observation, immediately kind of morph into something very utopian. And the minute it becomes utopian outside of this room, again, the connotation of that is, it's good to have a social conversation around it, but as far as our day jobs are concerned, it's kind of back to the old way of doing things. And so again, that's another observation, and I bring that one back on the onus is on this group again to say that this isn't about building an idealistic society. It's about saying that where do the immediate applications lie, what are the benefits of it, how does it kind of ease into the system. And I like to use the expression a Trojan horse, saying that we can slip it in, and then once it's in, it blows up in lots of different directions. So, kind of net-net, one thought I'll leave as part of my background and observations is to say that rather than going down the virtual currency route or even something like smart contracts, which seems relatively straightforward, if you were to take this across a few of the other industries, wherever you find the resistance to be less, I think that just gives us an opportunity to start putting that utility out.
Yes, actually, it's fascinating how even the discourse around these terms have evolved. We started out with fiat math-based currencies, cryptocurrencies, crypto ledgers. Bitcoin emerged as the first of many that had a high network effect. As its prominence dropped, blockchain became the term of vogue, and I'm sure we're going to see even more evolutions moving forward. Actually, one of the things that our group, as a working group, has been working on is creating a lexicon, a glossary of common terms, so that we can start, framing these concepts and clarifying exactly what these terms mean. One thing that I'd really like to tease out from this panel, given that we have someone from the London Stock Exchange, the builder of electronic trading, working directly with banks and institutions, pioneering some of the infrastructure for financial institutions, and emerging innovations. These technologies offer the promise of potential access to markets that were inaccessible before, more transparent and efficient systems within interoffices of these institutions themselves, but also the issue of disintermediation and the cannibalization of existing business lines. I've spoken to a colleague at a very, very large institution, and in fact there's inter-institution fighting in that you have internal innovators, but a big existing client base, unproven business cases. And I'm curious to know, how do you see, from your perspective, these institutions, of which there is a variety, addressing the disruption? Are they seeing disruption? Are they seeing opportunity? Are you seeing faster movement now that you did 2 months ago? What are the general trends that you're seeing in this wide spectrum of promise and peril of these technologies to their business?
I don't think there's one view. What I've realized, most of my career I was general counsel of joint ventures of big banks, and it was kind of like cat herding, getting the big banks to agree on anything. They have different business models, they have different technologies, they have different cultures, they have personalities. They're like any other organism, so to speak. And getting them to agree and figure out how they want to go forward in this space is difficult. So I think you see banks like Goldman Sachs have stepped in and made an investment in a digital currency company. UBS has stepped forward and has set up a blockchain lab. Other banks, I think investment banks, are sitting back and being maybe holding their cards a little closer to their vest. USAA, a firm that is not really perceived as a global investment bank, but really a service provider that came out of the servicing retirees and people in the American military, has admitted that they have a team focusing on the application of digital currency. So I think there's not going to be one uniform approach, but I think there is a general sense that it's worth exploring the potential applications. You're seeing the stock exchanges. Former CEO of the New York Stock Exchange, Duncan Niederauer, just joined the board of one of the digital currency companies. Blythe Masters, who ran derivatives for JP Morgan Chase, left her firm and has joined a digital currency company. So having gone through electronic trading, and I think Pinar may echo this, you start to see a lot of very bright people saying this is something worth exploring. And then the next couple of years, I think we will see an acceleration of experimentation with how the technology, the blockchain, can be applied in a variety of areas, including clearance and settlement, derivatives, transfer agency, compliance, just to name a few.
I'll speak and ask you, Amy. I think they recognise they need to innovate, not because of necessarily specifically the blockchain, but just typically in the industry there's this concept of digital banking, which in short means using the internet better as a bank. They have very old systems, a lot of systems, and integrating with collecting better customer information, engaging with the customer better, knowing who their customer is. Just all of this, they know that a lot of companies out there do that better. So a lot of them are spending a lot of money on that innovation because they're worried about fintech generally. Now incorporate into that what are better ways in which we can serve our customers, whether they be institutional consumers, with payments, or generally reduce costs, because some of these fintech companies under which you could put a lot of the blockchain companies are starting to develop this. They realize they need to put a lot of money behind it, which possibly they have underinvested in previously. So it's part of a broader picture of seeing.
Yeah, and to add to what you both are saying, understanding and figuring those issues out is a huge hurdle. In addition to that, you have a couple of legal considerations that you need to now map onto this. I've mentioned, kind of the payments challenges, anti-money laundering, and assessing your risks with this new technology that you're using. But in addition to that, you have cybersecurity issues, making sure you understand that and how that risk is now brought into your institution and you're protecting financial assets and financial information. and personally identifiable information in that whole bucket of considerations legally. And then also on that is just an e-commerce, a traditional e-commerce consideration. If you think like 10 or 15 years ago, we started, we're paper-based, mortgage, all kinds of financial assets, started moving digitally, and with the e-Sign Act, we were able to sign these types of documents and evidence ownership digitally, but there are legal requirements and protocols associated with making those effective, making that legally effective. And so now we need to take that to the next level with the blockchain, and how are we going to do that with this new innovation? So there are kind of a bucket of at least those three, and probably many more things that we need to understand.
Just a note on all of these. I think there is absolutely nothing surprising about banks looking into blockchain, because and them not necessarily doing this before, when it was more under Bitcoin, and people didn't really realize what was under Bitcoin. They didn't understand this piece of technology, and so as they realized, there is this piece of technology. It's actually really technology, and some of it actually is the type of stuff that they already had. They have ledgers, they have distributed ledgers. They are looking at, they actually build messaging systems between themselves, and they build new products on top of it. And all of these things actually happened before. So as they realized that this could be a paradigm which could streamline some of these, just that itself is very attractive, right? Just people just start looking at it, and that's the conversation to just start. But that's not the end of that conversation. That conversation is all right. So basically, I have all these systems. I can save cost, whatever. All that is the easy sell, easy attraction. And the next thing is actually for all of these things that we are talking about to actually happen. I believe they really need to be more about some kind of revenue opportunity rather than cost considerations, because. In my short history, what I have seen is, these cost considerations are nice, and first of all, before that, they could be actually more around, regulators telling the financial service industry to do this. It's just not going to happen that way, because it never happened that way. So usually in electronic trading, for example, there was this motive for creating new products so that you could actually push the clients that you wouldn't be otherwise do, and also for some players to redefine themselves and their own businesses in the marketplace. That really made things happen. So until then, you could have all these projects, you could have all the problems will be solved. Technology is not quite there, legal construct is not quite there. We can question if there is really this difference between this paradigm versus what they had before, and is it safer, or what are the security concerns? All of those are the type of things that needs to be solved. And they can be solved, no problem, but they are not going to, the sign-off, I believe, the real trigger is going to come from I think, the revenue and product opportunities or new opportunities that the banks would see, or financial services industry sees. And having said that, that's also, just throw something in there, it's not quite easy, because there are other considerations that will emerge. Like, for example, that in the panel that the panel was talking about, information asymmetry, transparency, is it a good thing or a bad thing? All those things are actually almost shooting yourself in the foot if you think about it. And usually, if there is a revenue, like a short-term revenue motive or short to mid-term revenue motive, then those things happen. And then that actually starts everything, and then the industry starts redefining itself completely, and then you start another cycle, if that makes sense. I will just leave it there for me.
Well, no, I think it's good that you brought up scalability as an issue in the technology as it stands today. It is, quite frankly, if someone wants to implement a very large-scale blockchain endeavor, it just wouldn't work. This is why we need sort of formal institutions, like banks, like software houses, whatever, to put in the time, the effort, the manpower to help solve these hard problems in cryptography. It's also worth mentioning as well that it's not just financial or traditional financial institutions that are looking into this tech. There's a lot of other people out there, sort of insurance groups, that sort of thing. But an interesting one for me is groups that already have a large network effect in areas that can't currently offer services through banking, for instance, sort of Africa. So imagine if you're a mobile payments processor and you have a huge amount of people who are using mobile phones on your service. All of a sudden you have this technology, blockchain, and smart contracts, which allows you to effectively build banking services into the protocol to allow you to be your own central bank, to issue credit, and allow people to have that credit as a fungible asset which they can transfer between each other. This now means that areas that were previously unbanked in Africa can have access to banking, but not through traditional financial entities, but through things like maybe Orange or Vodafone or something like that. Another interesting sort of use case that I've encountered recently when we were out in Singapore actually is tracking of supply chain. We have our own Dr. Jutta Steiner from Ethereum. She's building a startup which is essentially using the blockchain to track supply chain of individual objects that might form a product. Think of it in terms of fair trade, but with actual real statistics, real metadata, which is following around the individual components. It's called provenance. But specifically, imagine if you're a bank and you can see that a supply chain for, say, a boat out in the port, you can see you can basically have a greater degree of certainty that it has what it says it has. And from that, you can extend a greater line of credit, you can increase liquidity in the market. I think that's another really interesting use case as well.
One thing, it's interesting to remember Pinar's point about there has to be a motivation for this. In the United States, when electronic trading started, it really started in the 60s because of what's known as the paper crisis. They used to push stocks on carts around Wall Street. And you had to physically transfer share certificates between firms, and they had big vaults. And the volumes went up so fast in the 1960s that the banks couldn't keep up with it. And the United States government stepped in and said, you have to fix this problem. They passed laws in the 1970s saying we're going to create in America what was called the national market system. And they created mechanisms for electronic trading. Very early mechanisms, but there were companies like Reuters that stepped into the world, and NASDAQ was created as a quotation bureau. And that's where it started. Every time you see some type of market pressure, either trying to reduce costs, trying to improve profitability, or some type of market failure, you start to see the application of new technology historically. And I think here what we're seeing, we're still settling trades in the financial services world in large markets the way we did it 40 years ago, after the paper crisis. We can now do it electronically, but it still takes 3 days. So an investment bank is carrying balance sheet risk for several days. And during the last financial crisis, that 3-day balance sheet risk was very catastrophic. You saw firms going into a death spiral because they were having to roll their book around the globe every 8 hours, basically. And if they had been able to clear and settle trades more rapidly, they would have more cash on their balance sheet. They would have been less susceptible to failure. And it would have given them also, in a proper market or in a market that is not in a death spiral, it would have given them the ability to trade and generate more profitability and more revenue. So I think we will see investment banks focusing on clearance and settlement of all types of transactions using the blockchain, because it is going to allow them to do more trading and more activities as a bank, even though they have to hold more capital on the balance sheet because they've been required to do so by the big global regulators.
Actually, linked to that, I want to, it's a team which is bigger than really the blockchain team. It's just a financial services. In fact, it's a global theme overall. So if we are, what happened with the crisis, I mean, in the last couple of years, there is obviously increased pressure on capital. I mean, that's really what it is. And the banks really already are on that track of having to change their almost slightly business models, because the financial service industry has been built on small number of clients, high margins, and opaque kind of products. It's kind of how it has been, and there's absolutely, that's just the history, the way that things have been working. And but because of everything that's going on, in order for banks to really continue the way that they need to actually be able to sell their products to more people in the world. Okay, so some people talk about inclusion here, but it's not. That's kind of I don't know. I'm not really thinking about that phrase, but in order for that to happen, those more products to more people will be probably smaller margins, and they probably require more transparency and also more alignment of their processes, their siloed data structures, their siloed capital structures. business processes. So this was actually in yesterday's talk of Professor Shadab, I guess. I'm sorry if I'm saying it wrong. So it was more about also, this topic is more about really business processes as well. That whole effort that has been going on to realign the business models of banks to serve more clients and bring more access to more information throughout the system and scale through the world. So if to the extent that if this paradigm came up, let's say 10 years ago, like that, I'm not quite sure if I would bet on it being implemented at some point, because we were at a different phase at that time. Right now, with all these things going on overall, this is not regulators saying that you will need to do it this way. It's just trend is, I guess that's the push why we are here.
I wanted to just add on to something that Richard said before. One of the moving securities and so on onto the blockchain does sound like a good thing. We may be able to improve clearance times, reduce the speed at which it goes through. I think it's also worth considering. One of the bigger say a fallacy of the Bitcoin protocol is it's cheaper to move money. It's cheaper to move Bitcoin, but if you have the transaction fee on one side and then you move it internationally and then you have the transaction fee on the other and then you have possible spread risk, it starts getting pretty close to regular money movement. If you move the security clearance to a blockchain, we think it will be more efficient. We think certainly you can get a record from one point in the world to another faster. After you start adding all of the requirements of reversibility, compliance requirements, actually realizing the asset on the ins and outs of the system, we think it will be better. Has anyone done the analysis to, will it be? I think there's probably work to be done with that. But it's certainly promising. It's certainly worth looking at. But thinking of the ins and outs of the system as well is also a factor.
And I also imagine that at these large institutions where they have a lot of capital built up in the current infrastructure, where you don't have these accurate measures of cost, of provable business cases, where the technology will evolve, it probably makes it very difficult to justify an entire sea change within these organizations. And just the anecdote about going to digitization, we often see in this industry and even before that, with the advent of the internet, the porting of analog processes into a digital world. So it's I've heard this analogy. It's as though we're no longer living underwater, and yet we're still bringing our scuba masks, on land. And so this is one danger that I think we've all seen is the replication of analog thinking, where paradigms might have shifted with the architecture. So one thing that I'm curious to know is a lot of I've heard anecdotally that clearing and settlement is slow, not only because the process is anachronistic, but the technology itself is so old. To what extent are you guys seeing the resistance to doing an entire infrastructure change? To what extent is the promise, I think, that we all see of the potential of this technology to really create these efficient, transparent systems, driving significant efforts in this? We talked a little bit about the innovation labs. I know Ernst & Young was one of the first auditing firms and have made a big push into strategy. I find it very, very interesting that IBM chose Ethereum as their backbone technology for their Internet of Things proof of concept. How are you seeing this kind of adjustment to this sea change that we can all see but we can't quite quantify yet?
I'll start, then I'll take a break for a bit. There is a lot of money invested in it. So generally with banks, with any of this, they're very traditional, they're very conservative. They want to know absolutely what the benefit is. It's VC firms on one hand will put money into things that may have massive potential, and they play that game. Banks go on what's the quantifiable benefit, what's the quantifiable cost, is A greater than B, and I think that's why it's taken so long for them to get around to it. They were not, this technology. Banks are very innovative. in certain ways. I mean, you look at the instruments that they created back in the early 2000s. I mean, in hindsight, they were insane, but how people came to, thinking that this was a better way to structure was, is very interesting. And then when you look at their infant, but there was a quantifiable, A is greater than B. I think from the technology perspective, they just want to see that assessment. There's just a lot to look at because it's so old. And I think all of us here are, we're all sort of trying to work out what direction it's going. They are as well. They just want to see hard numbers against it.
Yeah. So for me, I mean, we've spoken to pretty much every large financial institution in London, at least. Also working with other sort of groups around the world, but it's very much a case of it's a fact-finding mission. It's education time. Like these guys they're getting the information they need to make concrete analyses of what this tech is going to be, and also as well finding. They know it's a solution. They know it's great. And they know it's really powerful technology, but it's also trying to find the problem as well. And also communicating what that problem is to them can sometimes be quite difficult. But yeah, that's specifically important. It's very so they're very much dipping their toes in. Looking at sometimes it's not going to be a case. I don't think it's going to be a case, certainly in the beginning, of entire replacement of sort of legacy systems. I just don't think that they'd be so expensive. As we said before, blockchain scalability will be an issue there. There's problems that need to be solved, privacy on the blockchain, etc., etc. Yeah, I guess that's probably how they feel at the moment. In time, I think as the technology moves forward, they'll be much more amenable to looking into and building actual systems. I mean, for now, they're looking at maybe small things like internal remittance systems, so they can maybe manage an internal budget with one section of the bank and another, and then use the blockchain to manage that. That's the kind of thing that they're looking at now. Nothing sort of big. Also, as well, it's unknown. It's an unknown variable. Is how can you get this blockchain technology to work with the legacy infrastructure in the back office? That can also be quite an issue as well.
Could I add something to that? Actually, there's a reason to those small experiments, because if you think about it, like really a real life bank way of making decisions, you usually have some kind of a committee or some kind of a sign-off process which is like a new product committee, whatever it's called. In every different bank, it's a different name for it. That actually, whatever project you do, whatever investment you do, whatever you do, you really need to ultimately, it doesn't matter who you are in that bank. You could be supported by the CEO of the bank, but if this committee doesn't really go through this process and approve things, it's just not happening, especially if your risk person is saying, no, that's just not happening. So if that committee is like, you have business side of things, so you need to have numbers on the case. Then you need to have, IT people, IT security people, data science, like literally different types of IT people that's involved. And then you would have compliance, legal, and literally in risk. And then I'm like, this is really a small picture. There's a quite long list of people who actually really needs to vet that decision. And when you're thinking about implementing something like this technically, you really need to be thinking about what kind of questions these guys could be asking. And then if you think about the approach actually that was mentioned, is if you look at like you go with a small project like that, you actually could potentially cover some of those questions. And then as you actually grow your projects and the scope of, and obviously the impact, is always an impact analysis of revenue, risk, all that kind of stuff. As the impact grows, then there will be more people involved and it's going to be harder. But if you actually, like as you implement a small, like a proof of concept, they call it whatever, at a business or a process that's not that difficult, then we actually could answer some of these security questions with it. You could answer some of these scalability questions. You could answer this very fundamental question about why blockchains are different than the existing process that I have, and like are they not databases or not? So you start answering those questions, and then you grow from there. That's, I think, the reason.
I think from a legacy institution's perspective, frankly, the concept, distributed identity management conceptually has been around for a while. Distributed infrastructure services conceptually has been around for a while. So I don't think it's that far-fetched for a legacy institution of scale. Clearly not talking about startups and labs. I don't think it's far-fetched for them to put their arms around distributed ledgers. I think the point made earlier, I think, is spot on with the e-commerce example. I mean, number one, there has to be a big problem which needs a solution. And what that essentially leads to is the business model. Saying, is there a business model for distributing the ledger? I think just flipping it around. Saying that by having a quote-unquote ledger in a centralized place, I think is fundamental to a lot of legacy institutions' business models today. And if you talk about distributing it, what happens to the business model? Not to say that there isn't one, but if you really want to start finding utility and finding spots, elements of the legacy infrastructure which could adopt this, I think the issue is, does that serve the business model? And if it doesn't, then what's a mitigating approach? Assuming that the technology delivers some larger intangible value. And I think that's fundamental from any legacy institution's perspective. Again, I'm totally discounting the anecdotal stuff, saying put some money here, put some money there, start up a few labs. But if you really look at things happening at scale, I think that's a basic issue.
And what I'll add to that, just being from a legal perspective, at a very basic level, these legacy institutions are custodians of assets. So if they screw it up, if they get it wrong in any one of these areas, they're liable. I mean, at best, you're talking about reputational risk, at worst, liability, in a number of ways. So there's all of that. So that's why we're seeing, just to add to some of these points, is these kind of offline internal pilot projects that will mirror some actual activity and to see how those map, but they're offline so that they can kind of track and carefully monitor how they can actually do that. And then probably maybe next year we'll be talking about how they've expanded from that.
I'm not going to cast aspersions or praise on any one bank or another, but I will tell you my experience has been there are industry leaders that are innovators. There are the ones that follow the pack, and then the ones that are just purely defensive. And in the electronic trading space and evolution over the last 50 years, you've seen that bear out, and I think we will see that in this space. Typically, the firms that are industry leaders are the ones that have their act together. They've got their business under control, they're very efficient, and they're constantly looking for ways to improve the efficiency of their business and to squeeze more juice out of the lemon or to deploy more capital to generate profits. And I think you can all speculate which one I think is probably the best. There's two of them that are very good at this, and they oftentimes are industry leaders in deploying technology. Then there are the ones that, I hate to say it, really will get involved in a technology like electronic trading at the tail end because they just don't want to be left behind, or they're worried that they will be part of an industry that is being shaped without them having a voice in it. So they will join a joint venture or they will form their own platform, and those platforms may not have the same success as the innovators. And then in the ones in the middle, who are doing the best they can with the resources they have, but they have legacy systems, they have other impediments to them being able to deploy technology and innovation as promptly as the thought leaders. And I think we're going to see that here. Over the next couple of years, my bet will be we will see a half dozen big investment banks invest in blockchain technology firms and set up their own blockchain labs and start talking about how they're planning on deploying the technology going forward.
That's fascinating and certainly consistent with the wide range of financial institutions that we talked to very early on in the space when these new exchanges and wallets were just emerging. I want to go back to this point about solving a problem. One might argue that Bitcoin, the first blockchain, exists because there are people wanting to solve a problem, which was the financial crisis and some of the systemic issues in our financial systems. One thing that when as a co-founder of an exchange, when there were very few exchanges out, one thing that occurred to us at the time was, well, we're technologists, we're innovators, our core competency is not deposit taking or AML KYC. Certainly when the banks figure this out, maybe they will think that they can do it better. And I think that has been proven out in some cases. You're starting to see this maturation with legacy institutions now really entering the fray. To the point of, we talked a little bit in our panel prep about how a lot of the change in technology at financial institutions have either been mandated by a government that saw a problem or demanded by clients who wanted better services. And with this disintermediation, with these new participatory networks, which expand access to capital, access to these products and services to a wider range of people, so it's not just a concentration of a few players that are driving a few clients that are driving innovation change. Do banks feel that power of decentralization is to their benefit, to their detriment? Do they see this potential opening up of various asset classes for more variety of people, something that can help them innovate and reach other markets, make more profit? With the issue with technology, the experimentation, the beauty of open source technology is that it's robust, it's open to experimentation. But also, you have sometimes a lower quality product. You can't control as many factors. So it's very interesting, actually, in the IP space to see the emergence of open source strategies at these financial institutions. That technology companies and financial institutions can't exist without having some sort of strategy on how they're going to open source things. So how do you see this kind of tension between this potential disintermediation, decentralization, changing really the market metrics of what drives change, both from the government side and within institutions from the client side?
I think the banks for, I don't know, however many hundreds of years are specialized in basically taking in and deploying capital. And that's what they do best. And if this is something that will allow them to do that in a better way, they will do it. But they do focus from what is the problem that we are really trying to solve, and let's build a solution for it. We have a lot of solutions in this space with no real problems, and they will they'll look at this, and it's I don't think it takes a whole lot to build out a blockchain if that's ultimately what they want to do, and they've got all of these labs looking at it, working out what is the best problem that is going to have the greatest benefit, greatest quantifiable benefit, and then they'll put some money towards it.
I guess and sort of issue there is if you have a bank which is using a private blockchain, then obviously it loses a lot. Well, the majority of the crypto economic security you get by having the public ledger, which is secured by a mining consensus algorithm or a proof of stake consensus. So, and in that case, if you're losing that crypto economic security and the benefits that come with being able to work on this open ledger, why not just use like an SQL or an XML database?
And that's the challenge, right? That's the challenge. The thing is, you're working in an industry. Well, I mean, it's true with any industry that everyone wants to make money. The problem with this is that the real benefit of it is when everyone's working together. So it's and that I think is also part of the struggle. Looking at it and thinking, how can we use this to make money? And say, well, you're going to kind of need to work with other people to do that.
Yeah.
So it's it's a different model.
Just one. I mean, disintermediation is not about blockchains. I mean, it's also they are dealing with this all the time. And maybe the analogy is the peer-to-peer finance analogy. It's really getting closer and closer to the traditional financial services, and investment banks are getting involved in these things, and they are beginning to see that they have a role in that landscape. And this is not very different. This is not a blockchain conversation. It's more around just basically redefining what you're doing and finding new opportunities. This is very similar to what happened in the history as well. So I think we may be able to take it as an example. I agree that there is a big question about this. I think of blockchains, this whole thing that we are talking about is a paradigm for them. And that requires a bit of a different way of thinking, maybe to fully leverage the benefits of what's going on. But then there are middle grounds, and then it becomes maybe closer to a database. And those are the questions that people are struggling with. I think if they find opportunity, there is two angles almost, this peer-to-peer kind of paradigm going on in a way in finance, and then you have the technology that actually really represents what's going on there, and potentially there are some analogies to be thought about.
Yeah, if we learn the lessons from, you look at the late 1990s. I was skinny then. had less gray hair, 28 years old. We went to the New York Stock Exchange and said someday this could all be done by computer. And we got into a bit of a discussion with them and literally were thrown out on the street by giant bouncers or security guards because the exchange at that time in 1999 didn't believe in electronic trading. Back then, there were shootings at day trading shops. And people literally said, why should anyone have control of their own brokerage account? They need to go to a credible bulge bracket bank or retail firm to trade their stock. And people were paying $100 a trade. And oh, there will never be a day where you'll be able to trade by computer or trade on your phone. That was thought to be just pipe dreams. Well, within 5 years, we sold to Citibank. One of our competitors merged with NASDAQ. The other one merged with the New York Stock Exchange and is still the backbone, basically, of their technology, a firm called Archipelago. And all of the brokerage firms had online accounts. And once the iPhone came out and the technology evolved, everybody, now you can trade through your phone. So I don't know where this is going to go, and I don't know exactly how the blockchain will be adopted by each firm. But what I do have confidence in is the profit motive of firms that are looking to deploy technology in ways that will drive their profitability and help them reduce cost. And that is going to create some new firms. TD Ameritrade was bought by, TD bought Ameritrade. Ameritrade was out of Omaha. They were a tiny little firm. They became a very large online brokerage firm. A firm called Daytech was acquired by Ameritrade at one point. Credit Suisse had its own platform very early on. So what I think will happen here is that we're going to see a fair amount of experimentation. We're going to see joint ventures and coalitions, and some of them will succeed and some of them will fail. And 10 years from now, we'll come back and we'll be talking about some new technology because the blockchain or some derivation of it will be incorporated into large-scale investment banking and commercial banking.
And in between, in 5 years from now, we will be talking about some products. Okay, this is the year of this product, it's the year of another product. You have like these things that are invented every year, and there is some kind of a hype around that. So there will be middle steps in between, probably.
So just to close before we open it up for just brief questions, we saw a little pie chart earlier today, was it yesterday, about how financial institutions think of the blockchain. If you that didn't know what it was, some percentage that you thought it was viable, some percentage that thought it wasn't. What percentage do you think of financial institutions by the end of the year is going to have some experimentation with blockchain?
90. Like, so many already have it. As someone said earlier on, it's not a case of it always being out in the open. I mean, you have UBS's level 39, Barclays has their kind of accelerator where they've got a few blockchain groups in there as well. But everyone has a little group of guys in a room somewhere who are playing with blockchain technology. You've got guys writing, not just financial institutions as well, but but larger groups, Microsoft, IBM. See little things written on the blockchain like Microsoft was here and stuff like that. They're all into it. They're all playing with it. It's just a case of, as I said before, they're trying to find the actual use case and then the profit motive.
I had a prediction about 2 years ago, actually, at that very first Bitcoin conference that I went to and heard about blockchain, that within a year, the banks, when they hear about actually the technology itself, they would be all looking at it. And then within 2 years, there would be like some sort of like implemented proof of concept or something small that's actually working that they are running. So this is, like that was the kind of the prediction. In terms of the financial services is big, I don't know the percentage, but that we could be thinking more about like more emerging countries, financial services institutions coming in, and it's already happening. But I really do think that we shouldn't be just only looking at large investment banks. There are just so many things out there, and I think they will be involved as well.
I think we've hit an inflection point. I think the area that will probably be hardest, and I look at my friends from some of the central banks and the European regulators, I think when you look at the Treasury markets or the gilts, I think there will be sensitivity to deployment of new technology with respect to trading anything that impacts the monetary policy or the ability to manage the economies of the major global economies. So I think you will see it being applied in certain areas by large investment banks. You will see boutique hedge funds experimenting with it. You'll see commercial banks. But I do think there will be areas where, out of, I would say, a pronounced concern for the global economy, then it may take a while for the blockchain to find some application.
I'd say, I'd say by the end of the year, I'd say 100%. I mean, I was putting together a list of our various clients with this space, and I was finding I was ticking every box that either, they've got a lab, they're hiring people, they're speaking with someone, and, I think it's, if you look at individuals within a bank, then yes, you're going to find some that are there. But if you look at the banks as entities, all of them are doing something with it.
Again, agreed with everything said. I think every large financial institution will, if not already is, experiment with this. The concern I have, though, is a little different. The unfortunate part about blockchain is the attention was drawn to it by Bitcoin. So the whole world started to focus on Bitcoin, and then some of them, a very small sliver in my opinion, have kind of narrowed down to blockchain. Frankly, if it were the other way around, there would be a lot more potential and promise, saying that if the attention had been drawn to blockchain as a distributed ledger, and then from there saying, oh, one scenario could be Bitcoin, well, maybe not for everyone. It could have gone in so many different directions. But that's the reality, that's the unfortunate part. And so my concern isn't about how many people will play around with it. My concern is everyone will play around with it, but then if they struggle to find good applications whereby this gets well and green, it's a fad which goes away. And I kind of go back 10 to almost 20 years and think about distributed identity management. Again, identity management, federated identity management, distributed identity management, and now it's kind of lost. Not to say that it's gone. So there are people who have deployed it. It is applicable. So the promise of blockchain, which I do believe in, again, I think I said this in the opening part, but I do believe in the promise, and if groups like this do not kind of flip the perspective around, my concern is less about how many people will end up playing around with it. You can assume everyone is playing around with it today as we speak. Why even wait for another year? But who will use it in a sustainable way whereby real value comes out of it 5 years from now? I would try and answer that and work backwards from there.
Well, with that, I'd like to thank our panelists and open it up for questions.
I think that's their way of saying they're hungry. No questions.
This is a committed audience.
Thank you all for your insights. I just have a question about the purpose of the discussion. In terms of, we're talking about how, as I understand it, how banks will or will not use blockchain, which to me is kind of like a discussion on how factory farms will or will not use genetic modification to make themselves more efficient. What's the greater purpose of this? Because we're talking about a centralized system. I think someone mentioned that they are liable and they have responsibilities, etc. But I'm not sure if that's a different reality, because the one that I've lived in the last few years has shown that they're not liable and that we bail them out if they make those mistakes. So I guess my real question is, what's the purpose of our discussion here greater than the mechanics or the efficiencies of a centralized system?
First off, I'm going to respond. If you take a look at the amount that banks have paid over the last decade in response to the financial crisis, they have paid trillions of dollars. Now, does that equal the amount that was made? No, of course not. But if you look at other highly regulated industries and the fines that are imposed on them for catastrophic events in comparison to what happened in the financial crisis, I think there is a bit of a misnomer that the financial industry gets bailed out and doesn't pay penalties. I will always take issue with that, because every bank that received TARP money, for example, in the United States, paid back their TARP money plus interest. Many of those banks, if you read Aaron Ross Sorkin's book on the financial crisis, will state that they didn't even want to take the TARP money. They were forced to because the Treasury Department did not want certain institutions to fail and to create a cascading domino effect across the financial network. So I'm going to stand up for my clients. Second, I think when you talk about how is this going to work, there is, I think, a schism in this community. There are the utopian ideologues going to save the world. It's going to solve world hunger. It's going to bring manna from heaven, and aliens will arrive and they will look at us all and think we are their equals. Then there are the doomsayers on the opposite side who believe that it's going to bring Armageddon apocalypse and the destruction of the planet. I think it's somewhere in the middle. And the question is, how do we take a truly innovative technology and implement it in a way that it will reach its full potential? And if you think that this technology will reach its full potential without one of the largest parts of the global economy being involved, the financial services sector, I think that is fairly naive. So that's why I think this panel talking about how institutions will deal with it is important.
And just to take it down to a more practical level of where we are today, and notwithstanding where we may be in the future, and where on that line you may be, which I think is very diverse in this room, and part of the beauty of this technology. The reality is, if you're an innovator, you are playing around with code, creating a product that's really useful for a lot of people, you still need to, if you're in financial services, have a bank account somewhere, and you have to make a partnership somewhere, and you have to access the few monopolistic rails that exist today in order for your business to even reach market so you can test your product. So because the current situation now is that we have centralized systems and monopolized rails, in order to be able to break that market, to enter that market, you have to work with legacy players. And right now, because this is a very complex technology, because it's the first application was financial applications, which is one of the most heavily regulated in the space, you're seeing this weird confluence of private economic interest, distorted political discourse, and distorted public understanding of what these technologies can do, which then drive actual policies, which then drive actual things in the real life, in the real world, that prevent entrepreneurs and builders from being able to do what they need to do. So the purpose of this panel, and I'm guilty as someone who curated it, is to really explore where that intersection is, for us to learn from people who are talking to legacy institutions what their thinking is, how we can maybe align incentives, and maybe where we can disrupt the roadblocks, and move the ball forward from there.
But I think I think it's one of the topics that just hasn't been addressed enough, because they are looking at it. They are all looking at it. They have an immediate larger network than any of the current blockchain cryptocurrencies out there, and they could spend not a whole lot of money relatively compared to what they've got, and make every single altcoin irrelevant. So I think to look at this and not think that they're going to get involved is short-sighted.
Okay. Speaking of legacy institutions, I have a question for you, Angus. So it's I don't know if you're aware of Wikistrata, which is the first consulting company which is open source, so they can just draw consultants open source. And I'm just wondering, how are you looking at it from your perspective? And speaking of, standing up for your clients, which some of them are here, and the new trends which are starting now.
I think that's it. I haven't heard of that, but I will look at that. We defining exactly what we do or what any of our competitors do is very difficult, because we change depending on what our clients need. Hence why we, as an industry, have the rather nebulous name professional services. We work out what problems the client has, and we will assemble teams, develop knowledge, incubate solutions, and go to market with that. I think the model that you're saying is a very interesting one.
If I were you, I would join them, but it's okay.
There are two things. If you take our auditing side, that would be very difficult to move to that model, I would think, just because of the whole purpose behind auditing. Is that we need to be a partnership for that, because there needs to be some sort of personal liability if you're signing off on companies' accounts, because that has that has an important part of the greater financial system. In an advisory perspective, I would need to look more into it, but the reason why, one of our strengths is that we have a large network of people that have developed long relationships in various industries with various clients, and frankly that's our strength, and that's any of our competitor strength, and whoever has the stronger relationships and the broader knowledge and can share that more effectively within the organisation. So decentralising that, it's something interesting to look at, but I think that, you know, because trying to nail down our model into a, you know, the business, it changes that answer a little.
Could I just add one thing about this, like give it a specific example about monopolies and what I was thinking about this, we talked about electronic trading, maybe we should put that in context a bit more, what that actually, for example, meant. I actually was working at London Stock Exchange until 2 years ago, and the reason I went there is probably because I worked on almost every project that created competition to London Stock Exchange before. And so London Stock Exchange used to be, you know, basically before it was a regulation called MiFID in Europe, used to be a monopoly with, you know, almost 100% of market share in trading. And this regulation came up. There is always the advancement of the technology, electronic trading tools and the routing tools and the marketplaces and all that. And so banks, I mean, for a number of reasons, some of them actually profit-orientated, some of them cost-orientated. There are a number of things. I'm not going to get into that. But they got into them. They basically put together these projects that created competition to London Stock Exchange, which drove down the market share of London Stock Exchange quite quickly, and created a whole new market structure, way of trading things, and actually even new kind of products and access mechanisms, networks in Europe. So that is actually a very real example. Only thing is that, like, okay, so this is a bit linked to that kind of conversation. I think we are having similar type of. I mean, that is a bit of the context. But I will leave with a question. This experience, as nice as it may be from one point of view, it still also is, there are lots of people who actually would question this experience and the results of this experience as well. And I mean, banks, businesses changed and they went through this experience. Some of them were winners, some of them, it's just literally, I don't know, it's a whole different panels or whatever. But the point is, this is the industry which is looking into now use of technology, like I call next wave of problems and questions, and they want to do it in a probably different way. And these are the things that I am very interested in working on. So maybe this is that's to put a bit of context.
Well, thank you guys again, and thank you for staying. We're going to take a 30-minute lunch break and then be back in this room to continue the program. So thank you again.